2023, deposit pricing has become a real challenge for the banks. Interest rates climb, they got to pay more for the money, people are looking to get the most they can for their deposits. The strategic part of that is they need the deposits to offset the compressed net interest margin on their loans to create profitability and generate money for the borrowing pool. Strategies that banks are using to increase their profitability and their liquidity are to take the money from those loans that have been paid off, set that aside in capital, use that to pool their liquidity, offering rates on, I'll call mid-term deposit pricing, not long-term, and then obviously using the Federal Home Loan Bank and Fed funds to buffer some of those short-term needs. In the current market, liquidity is a real challenge for institutions. There's a couple of tactics we've seen happen. One is they're taking loans that are being paid off and putting that money back into their capital to increase their liquidity. The other is they're getting more aggressive about attracting short-term deposits with higher rates to increase liquidity. And ultimately, we've seen them buffer short-term challenges with using Federal Home Loan Bank and Fed funds. We've seen the concerns over regulatory compliance and risk increase in the prior year due to primarily the Silicon Valley Bank and First Republic incidents that took place. They're pushing that regulatory burden and oversight down to the large regionals and mid-markets, which has historically been reserved for the larger financial institutions in the country. That, coupled with the partnering with fintechs and the regulatory and compliance oversight on fintechs that the banks are going to be responsible for, and then the ultimate integration of AI into those institutions is going to create a burden for the examiners to evaluate those institutions on. In the past, larger institutions in the United States would waive fees for customers of a certain type. Regulatory scrutiny is now requiring those banks to treat all customers the same, whether they're commercial or retail. And so in lieu of waiving fees for certain segment types, they're waiving fees across the board, or basically negating fees. This is forcing smaller institutions to follow suit. Customers don't want to pay for bounce check fees, account analysis fees, those types of things. Much like they did in the internet banking bill pay days when the big banks quit charging for those services and the smaller banks had to follow to stay competitive. The use of AI is going to become more predominant, and I say more predominant because we've used intelligence to do analysis in the risk areas of the banks before. Anti-money laundering software would be one indication of that. AI will continue to progress where it makes more decisions, more enhanced online account opening, extension of credit without human intervention. Institutions are going to have to ramp up their vendor management program, their risk management programs, the expansion of their governance programs. And really what they should be deploying is more due diligence, unlike they did in the cloud computing age when it was find the cheapest cloud computing source, move all your data there, and stick to institutions that really have a track record in AI in the financial services space and a proven tool that is successful and can help minimize expense and increase efficiency in the institution.